Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Good day, everyone. Welcome back to another episode of the Property Nerds podcast. I'm your co-host, Arjun, joined by Jack Fouracre from Fouracre Financial. Today's episode, we're going to get deep into the world of SMSF. This is a topic that I've covered off in the past, and I haven't actually done it though with Jack. And the reason why it's so important to go through it today is more than ever in a high interest rate environment, we're noticing people look into SMSF as an option. And this is for multiple reasons. One, people from back in the COVID day when the pandemic first hit, they felt that control was taken away from many aspects of life. And post-COVID, that control of your financial future, what you want to do, where you want to be, how you want to get there, we noticed a huge spike in that. And so that also corresponded with SMSFs turning up and having much more of a setup, review, questions, even on the search terms. You can search all around for them. That picked up from then on. But the second thing is that as interest rates have gone up, borrowing capacity has really been crippled. And as a result, that's changed people's thoughts on which assets, which vehicles they go to extend their borrowing capacity. So we'll talk more to that today. But SMSF, if you're someone that doesn't know what that is, it stands for Self-Managed Super Fund. And we're going to look into the deep dive of SMSF and essentially the evolution of SMSF property investing. Now, you might get, I might trip up on the word SMSF so often because I can only say an acronym so often that cleanly. But the main thing here is that we've seen it pick up, we've seen the questions come in, and you all want the information on this. So we're going to give it to you today in a bit of a deep dive. Now, in today's episode though, first thing I want to point out is that we're going to be going through a research paper that's released on the evolution of SMSF property investing. And this particular research paper is actually something that we've done very uniquely. We've collaborated with a research firm that's allowed us to get deep into what we call survey-based research and researched over 400 people to come and share their thoughts with us around, SMSF, where they are, their thoughts on it. So from that perspective, it's only this place. Like, you cannot get this research anywhere else because it's custom through the survey responses, designed questions to really unpack what people's thoughts are, the evolution of it, the impact of it, and where they're going to go with it. So can't wait to unpack that. But if you're looking to download it, it's on InvestorKit.com.au and you can check it out. It's the evolution of SMSF property investing, a free research paper there for you to learn more about how SMSFs are actually transforming the property landscape in 2024. And in that report, we cover off a few things. So one is Australia's retirement plans and I guess Australians' retirement plans and concerns. The second is superannuation and just the investment of it. The third is SMSFs and retirement planning and how that comes into the mix. And then lastly, the whole FOMO aspect of SMSF awareness, because there seems to be a lot of things happening in that space around people's fear of missing out and looking into this as another vehicle. So yeah, just again, it's investorkit.com.au if you'd like to download that research paper. But other than that, let's dig into where SMSF first starts. It's usually on the finance front. Jack, you're getting a lot more inquiries in this space on the world of property investing, specifically here for SMSF. Why do you feel that is? Like, what's in your opinion been the biggest reason for people inquiring about this now?
Yeah, there's a lot of different reasons people would spark that conversation and ask the question. One of the most common ones is that they do hit their borrowing capacity limits in their personal name or within other trust structures, and they look to their super as a way to borrow, because obviously the super that your employer pays or that you pay yourself, it's not utilized in your borrowing capacity outside of super. So it's like a fresh set of eyes of your borrowing capacity based on your income. So that's a really common one. A lot of people are not satisfied with the performance of their super with the retail fund. So that's a really common one as well. But yeah, I think there are some people that don't want to necessarily invest in their personal name or in other trust structures, and they're just happy to kind of get a couple of properties in their super. And, there's a lot of tax benefits in retirement when selling a superannuation property. So they look at that as a good option, as a good way to cash in on the way out. And yeah.
Awesome. Now, Jack, we're going to definitely get some experts in the future to join us in different segments of the show, accounting, financial planning, because in the world of SMSF, we can't formally give advice here. And anyone listening to this shouldn't be thinking of this particular episode as advice. It's more just us explaining the landscape of what we see, what the banks do, what the property investing side shows up. And so on that note, Jack, you talked about borrowing capacity, people extending it.
Yeah.
How is it different and why is it different?
Yeah, so obviously the super contributions that are being made, that's not something you're utilizing for living expenses or lifestyle. That is going to your super automatically, right? Now, when a lender's assessing your ability to borrow within super, they're just looking at the super contributions. That's it. And you can allocate extra contributions, or if you show a history of extra contributions, that'll increase your capacity. But your capacity is quite good, especially if your minimum income, 150K household income, 150 balance in your super. Those are just really basic guidelines.
Yeah.
There are outliers. Like you could even go up to a 90% LVR in a residential purchase. You can go all the way up to 80% LVR on a commercial purchase. But generally the way they look at it, your capacity is quite good. And if your income's really high, you could be quite aggressive there without it affecting your individual capacity too much.
Yeah, so on that borrowing capacity part, that's a really important point you raised, because what people should hear when hearing what you've just said is that with SMSF, even if your personal borrowing capacity, say, maxed out, and maybe you had $2 million of personal borrowing capacity and you've utilized that all across investments, your home, and you're done, you're going to get an extra borrowing capacity that's separate to that simply by having the vehicle being in super. Have I got that right?
Yeah, that's right. And people like it because it's not something that takes money out of your pocket if you do it right. If you say you have 250,000 in your super and you allocate 200K towards the funds to complete, the deposit, any fees to acquire the property, and then you've got the 50K there as a buffer, that's generally going to cover any negative expenses for years, right? And so it's not really going to take money out of your pocket if you do it right. And that's why people like it so much.
Yeah, because if you've got that scenario, what I'm hearing is you'll have your rental income come in.
Yep.
You'll have money used for the purchase. You'll have buffer left over on that purchase. And then your two, say if it's a husband-wife combo and they're investing, you're going to have super contribution from both people.
That's right.
Cover the shortfall against that particular property.
Yeah. And generally with a double household income or a high household income on just one side, it'll cover it. With that contribution going in and the rental income coming out, the buffer's just a formality, but it should cover it, especially in a high interest rate market. Over time you have rents going up, you have interest rates coming down, so it's only going to get better. But with the buffer, it's good to have a buffer so that you don't have to make extra contributions to your super. Depending on your age, you may want to do that. So yeah.
And this is where like financial planners typically come in and they'll go, well, you've got this much allocated to property, this much allocated to other types of investments to keep it diversified, and then this much in buffer. And so when I'm hearing that, like that's a really positive outcome, because if we strip it all back and you go, what is this? It's like essentially buying another property, using leverage to your advantage in a fund rather than having it all sit in a singular vehicle with no leverage. And then the third thing is you can still diversify, you can have more control, and the repayments that are there from the negative cash flow that typically exists is not chewing into your personal lifestyle or living.
That's right.
So like, I can just see why so many people are like now going, I want to go and set this up, I want to go and do this. Talk to me about the actual borrowing side though. Like when it comes to now you've got a separate borrowing capacity, is it as different from the cost to borrow, the process to borrow? What changes there?
Yeah, so not every lender will do SMSF loans. Like the major banks and the well-known banks, they're not really in the space. So it's a lot of banks that you've probably never heard of. But the rates, because of that reason, the rates are typically slightly higher, not ridiculously higher if your circumstances are good. But yeah, it is a bit of a different process because there is a trust involved. There's also a bare trust involved. So it's foreign to most borrowers, and it's actually foreign to a lot of brokers too. A lot of brokers don't actually know it that well, and so it's really important not only to get a good team on the finance side, but also to have an accountant there that can help advise you, because on the accounting side, it's a bottomless pit of strategies. There's so many things that you can do with super, and to have a good accountant that understands all the different avenues for yourself, especially if you're self-employed, there's a lot of good ways you can utilize it.
Yeah, I think on that note, with the broker parts, it's really key because I'd say less than 5 or 6 lenders that do SMSF really competently and easily in comparison to 30 plus for non-SMSF lending?
So there's actually a lot more lenders that do SMSF now.
Okay.
But there's only maybe 4 or 5 that do it with an offset account. So,
right.
And
that's another thing I didn't think of.
That's a big one. Because a lot of non-bank lenders, like the ones that most people know of, they'll have an SMSF product just for the sake of it, but they don't have the ability to have an offset account. So
that's because they want their market share, right? They're seeing how many people want SMSF now. Yeah. They're like, oh, well, why don't we let you in back again? Sorry, we couldn't look after you before, but now we can.
Yeah, mate, there's new lenders coming in doing SMSF all the time, but there's a really small amount of lenders, 3 or 4, that'll have an offset facility, which if you are planning to have a buffer or build up buffers, an offset facility is a no-brainer. If you want to implement a pay down strategy or improve the cash flow because you've got an interest-only loan in the super, if you don't have an offset, you can't do that. And unless you want to have a loan that, have a superannuation loan over a 30-year loan term and pay it off in 30 years, because that's what's going to happen if you don't have an offset, then, looking at a lender, maybe not initially. Some circumstances you can't qualify for that type of loan, but you've always got to have the plan to, get in with what you can and then get to a product that has an offset account so that you can help pay down that loan a lot quicker.
Yeah, so this stuff feels like common outside of the world of SMSF, but it's really important that people know that it's not very common in it, right? And so by having them, they're actually X factors because you've got the interest only versus P&I, you've got offset accounts, so your money's more liquid, but you also have choice with it as well.
Yeah.
But the other thing is, if people are considering SMSF, if you're in your 30s, with a typical P&I loan term, if that's the way you go, you can almost guarantee that it's debt-free by retirement age.
Yeah, definitely.
And that's the power there. Like if you're leaving this too late in life, you might have less of an advantage on the property side, if you're going residential, that is, in comparison to other investments, because there's cost to set up, there's cost itself to actually hold the property, there's interest rates, there's maintenance and all that stuff. And I'm a big believer of being real holistic with your property decision, not just looking at it from, great, I got a loan now, so I can buy more property, it's a winner. If you're in your 30s and 40s, I think that's like a very key time, because you're in that time where you know that if you get leverage, you can also have it be debt-free from rents rising, P&I repayments, and you've access to leverage, but you also don't have any more debts in the consolidation phase when you're trying to get that income.
Yeah.
Now, we've talked resi. In terms of SMSF, I want to share a couple of stats though with people from this research paper. And so the first one, this was interesting, some of the key findings. Australian investors feel they will have to work beyond typical retirement age to retire comfortably. This was pretty scary, right? 26% of property investors in our survey here predict that they will need to work until over the age of 65. So just taking control of your future. Now, how important is that? I might shout out one more stat, and this is really, really cool. So property investment and home ownership is a priority for almost all Australian investors and a major part of their wealth building strategies. 82% of Australian investors say residential property ownership is their primary investment vehicle. So you can just see how important residential property is for investors. And if they're looking at that, really getting that maximization through leverage, borrowing capacity, this sort of stuff's in SMSF. But there's a world of commercial property that many people don't know about. What are some of the core differences in SMSF you find that in commercial, from a finance perspective, are a bit of an X factor?
Yeah, so your borrowing capacity is actually a lot better when you're buying a commercial property, due to the fact that the cash flow is double, sometimes triple, depending on the purchase price, whether you're on resi or commercial. But man, I know anyone listening to this who's heard podcasts or had experience with commercial property outside of super, they would know that there's LVR restrictions, there's shorter loan terms as well. You might be surprised to know that in SMSF you can go all the way up to 80%. You can go 30-year loan terms, right?
So you're talking resi style lending, but for commercial,
and sometimes better rates than what you get outside of super. So, mate, the lenders that are operating in the space for SMSF and commercial, really good, really, really good terms on the loan, and the borrowing power is actually better due to the fact that it's really high cash flow and those loan terms are actually similar to what you get on resi. So if you can get a high enough purchase price, it might be worth going commercial. But if you don't really have a big enough balance, or you don't really have the means to get a high enough purchase price on commercial, a lot of people would tend to go residential first and then build up that residential value, maybe add a second one or sell it to add two or something like that. Because when you're trading up or selling a residential property in your super before retirement, you still get a pretty decent capital gains tax discount. So the exit cost isn't so significant. So trading up is actually quite common because you can't utilize the equity in a property within your super fund. It's not like outside of super when you've got equity, you do an equity loan, cash out, use it as a deposit. Can't do that in super. You kind of have to just wait it out or build up the cash in the fund from the rental income and the contributions from the employer, or sell it, take that big deposit, split it up, get a couple more, or take that big deposit and maybe have a big enough deposit to do a commercial asset.
Yeah, so you've touched on an interesting point there, which is firstly the LVR, 80%. What people should recognize when they hear that is outside of super, yes, you can get some 80% loans in commercial, but a lot of 70% seems to be the common playing field. So you need more deposit. Now, many people don't have that deposit on the side, whereas if they're in their late 40s as a couple, suddenly their super balance is big enough over life of working that they're in a position where they go, well, we could buy a commercial here. And that suddenly becomes available to them. But what you touched on is the importance of like realizing you can't take equity loans in super. What we come to see in InvestorKit a lot is that when you have superannuation purchases, the style of purchase you can make is actually different to what you would make outside. So outside of super, we'd be really focused in on going, hey, we need short-term growth drivers that are really strong. We want to leverage that equity. We want to use leverage loans of even 90% plus to get you into that next property. So you have a larger compounding value base of assets that goes with you over life. Different game in super.
100%.
In super, we're like, we want to hold this property for 20, 30 plus years.
Right.
We want to make sure that this property is going to also stand there and be not falling over in that time too, because you don't want to keep going backwards with your balance and repairs, maintenance and stuff like that. And then lastly, we also want this to be an asset where it hedges the strategies you're doing outside. So to give you an example, let's just say there's properties outside of super where you feel a lot more, aggressive, or risk management's easier for you to manage and you want to go for it and you want to attack the short-term metrics to see that growth. In the super, we want to do the opposite. So if you're all of a sudden in Queensland for all your investment properties outside of super, we might go to another state for super that doesn't have an immediate short-term horizon that's really, really strong, but we can buy in a good price point. We can get a good place. We know the long-term stats are really solid there. And you're not going to be touching the equity of that anyway for 20 to 30 years. So if it can compound and do its time, different story. And so that's something to look out for that. But when it comes to commercial, another thing we should probably touch on is the SMSF as a vehicle, once positive cash flow, is very different from personal, right? Like, when it comes to the tax rates, commercial property is typically positive cash flow when you're buying it. Now, when it is that, in personal names, your tax rates are higher than what you have in SMSF. Now, they'll vary from person to person and what you are personally. SMSF, it's lower as a tax rate than personal. And so what that means is if it's a vehicle that's holding an asset that's likely to be positive cash flow, you're just going to have more of that money in your pocket in the long term instead of if it was in a personal name.
It's literally built for retirement, right? The government have put this in place for retirement. They're still taxed, but they're not going to slam you with tax on your retirement. This is built for people that are in retirement age. And this is close to me, mate. My parents would have been one of those statistics if they didn't buy a property in their super. This is something that was, I know their situation. I know what they did, work so hard. That one investment in their super set them up for good. And seeing that has made me, that's why I know so much about it. Like I followed them along that journey with them and was able to see it happen for them over a period of 10 years. 10 years before retirement, they started doing it. And they wouldn't be retired. They'd still be working now past 65 if they didn't do it. So this is something that me and my brother, we've both joined forces and we're doing a superannuation investment. We've had it for a couple of years now, and it's really powerful.
Absolutely. We've seen so many people's lives change considering it. Now, on that stat and super, so we talked about in this report that 65%, this is what we found, of eligible Australian households. So we set the eligibility mark at 200K or more balance in this survey. Now, it doesn't mean you have to have that balance to buy property. We've seen people purchase property with us with 150K balance.
Even 100.
Even 100, yeah.
For
We've seen
really
some people
high
take it.
income earners, you can go up to 90% with 100K balance. Like you can still get a property for 600 if you're really high income earners, because at 90%, obviously rates are going to be higher. There's
Correct.
fees and all that. So you'd want to make sure that you're not going to be having to put so much money into it to make it work. But yeah, it can definitely work.
Absolutely. So we've seen that it all depends on the advice you're getting and what you're actually doing with that money and making sure you're weighing up all the fees and charges. But what we found is if we set for this report here, 200,000 is the balance between a couple, 65% of eligible Australian households are not using an SMSF, which is really interesting. So whilst it's picking up massively as a trend, there's so many people still not using it just because of a few issues that get in their way. And this is what we found. I have not considered using my super to invest in property via a self-managed super fund because I don't know how to do it, because I don't know how it works, and because I don't have enough information on it.
100%. I was just going to say that, man. That's exactly right. People don't even know what that stands for.
Yeah.
They hear it and they're like, what is that?
Yeah.
Yeah.
And so for the rest of this episode, we're going to make sure that we can help you in answering these three questions. So let's go a bit through a little bit of a masterclass and go through a couple of quick points, right? I don't know how to do it. So step-by-step process. Firstly, you want to consider getting advice on if it's the right thing to set up for you. And that's considering your options of what your current fund's doing, knowing the pros and cons of setting it up. And your starting point could be with your accountant, with a financial planner, because they'll introduce the right people or they are the right person themselves. Second step is once you've gone from the setup, you want to then make sure and you've considered all your options, the fees and charges will be, you want to go through a rollover. So the rollover is when you're then having the support of your accountant or financial planner, start to get all the funds from where your super is kept and move it into the actual fund itself. Third step is consider finance if property is going to be one of the options you take. And in that's where you can reach out to Jack's team here. Jack, what's the website for you guys?
FouracreFinancial.com.au, mate.
Awesome, mate. And how do we spell the Fouracre?
Fouracre.
Perfect. So have you always wanted to be on 4 acres? Do you reckon that'd be a goal for you now?
100%, mate. 100%. I'm just waiting for that right property that's on the dot of 4 acres and I'm getting it.
Generational retirement living there. Chuck that in the super, huh? So that's the next step, is getting your finance evaluation. Now, if you're looking to have a professional on your team, this is the step afterwards where you can engage us at InvestorKit.com.au. Typically for us, though, we want to see a balance of 175K or more. It's not because you can't buy under that. It's because we really believe in risk management with the right buffers. We really want you to have the right diversity in your fund. And we want to give you suitable options that across the country, you're making the best call. It doesn't mean you can't invest less than that on your own. You don't have to use us, but this is more just giving you the step-by-step as part of a tutorial. Now that you've got your finance underway, you've got your search starting for the property, this is the part I want to stop here. Everything after this, I want you to think of it as a normal property transaction, right? Which is you purchase the property, however, on the contract of sale, it won't be your name. It won't be Mr. and Mrs. Smith. It'll be the name of the fund. And with that fund, some states will have their names change. Some will just have the fund as trustee for another fund, and that's because of the Bear Trust. Some will have the PTY Ltd only of a Bear Trust company, and I'll get through these technical terms. But the main thing is just taking a step back and realizing this. Your superannuation is taking a loan out, and so to manage the risk of it, it separates that risk by having an entity that's liable for the loan, not the whole fund itself.
It's called a limited recourse borrowing arrangement.
That's it. And with that, you're able to then have what's called a Bear Trust setup. And to avoid the confusion, just basically tell your accountant, I'm purchasing a property. Here's the address. Here's the location. What do you want me to put on the contract of sale for this specific state? Because it varies from state to state. How many days do you need, in our opinion, between 2 and 4 max, to set this up so I'm ready to go? Now, some people have taken longer to Bear Trust. I'm not saying your accountant sucks. I'm just saying we see enough that the most common is 2 to 4. Then you're able to purchase. I'll stop here, Jack, and I'll hand over to you. When they're going to the lending part, what are the slight differences in the lending? Because they've come up to you now going, Jack, I got a contract of sale.
Yeah.
I've got all these steps here. And anyone who wants to go back, just rewind this podcast a little bit so you can take it step by step, drop some notes in. They come to you, Jack, and they go, I'm ready to now purchase. Here's my contract of sale.
Yeah.
What's the next step that's slightly different?
So you don't actually need to, like before that process, you can have a pre-approval. You don't need to have a contract and a bare trust before going and getting the finance.
That's
right? If you've set up the SMSF, you can have a pre-approval, like you can apply for a pre-approval with that SMSF. And then obviously once you've found a property and you've got a bare trust, then that's what goes on the contract.
Yep.
And then with that contract, you give it to the lender who pre-approved you, they'd get a valuation done. And that's it. Am I missing something, mate?
Now, I think there might be a little bit the loan docs because we see some people trip up here a little bit. The slight
advice?
Differences, right? Could you explain that a bit?
Yeah. So once you've obviously got the formal approval, there'll be independent legal advice that's required before you sign the loan documents generally, you'll need to go and speak to a solicitor and they'd have to give you independent legal advice. And that's always got to be a physical document. Like, although now a lot of SMSF documents, loan documents are digitally signed, that independent legal advice needs to be a physical copy printed with the solicitor and actually sent back to the bank physically, which can cause some delays with settlement, but generally if you're on top of it quick, it should be fine.
Yeah, absolutely. So this is just all about the power of working with someone because you guys do SMSFs all the time.
Yeah.
If you're going to work with a broker who does nothing but look after first home buyers, the downside is that they're not going to see that across their desk much because first home buyers typically are in a younger age cohort and also they don't have large super balances. And also when you're looking after that client base so often, you're not going to be dealing with property investors who have super in front of mind, right?
Yeah.
The next thing here is that you're going to go through property management, finding a tenant, taking up insurance on a property, pest and building, pre-settlement inspections, settling the property, and then actually having it rented out. Getting a depreciation report. So these are the typical common steps that occur. None of these steps are different to personally.
Yeah.
So all the same happens, except you might have an invoice in a different name, a receipt in a different name. And then once you've settled, the ongoing management might be slightly different. You'll have tax returns in your self-managed super fund. This is your accountant. You'll have advice plans to follow, perhaps from your financial planner or accountant around, hey, you've got this much money left over, considering that in maybe stocks or considering that as buffer in your offset accounts. And that's the key differences. So if we pause a second, there were 3 core points for Aussies in the survey. I don't know how to do it because I don't know how it works and because I don't have enough information on it. So I don't know how to do it. I hope that step-by-steps helped you in answering that. And if you want to take a moment to rewind and understand who can help here, fouracrefinancial.com.au on the finance front. We can also connect you with the right accountants and financial planners if you feel that your person isn't very SMSF knowledgeable. And then the second part is InvestorKit.com.au when it comes to actually the purchasing of a property in SMSF if you'd like someone who can tailor it to that vehicle. Then you've got the next one, because I don't know how it works. Jack, what's your one-liner to explain, we've done the how to do it, how it works? Like, what's an SMSF? How does an SMSF even work? What would be your one-liner there?
Man, it'll be very hard to sum it up in one line. But, once you've spoken to the accountant and set up the SMSF, that's when you can start the finance. Then you go for a pre-approval. It's really, people complicate it. Like they think it's a complicated deal because you're doing a trust deal. But all it is, you're just adding a trust. Everything else is the same. All your documentation, you give it all, and it's really not that much different to a normal application, especially if you do it so much. But yeah, it's really not that scary.
Yeah, I agree with you, mate. I think my best summarize of because I don't know how it works and I don't have enough information on it. So firstly, on the information part, you've got 3 to 4 core professionals: the accountant, the property professional, the finance professional, and the financial planner. So some of them will have a hybrid, some will introduce others to help you build that team around you. And that's going to be the part of I don't have enough information on it. Each of those steps can unpack that information. And I hope this podcast can also help you unpack the information. But I don't know how it works. If I just simplify it and go this, actually, I'll take one step back. You're setting up a fund gaining the power of leverage fund or a superannuation company. Final part is you're keep in there how much you put into share advice on it. Are you doing it on your own? Of SMSF. We go through, the data that's really unpacking every bit of survey questions that we had. How many Aussie investors feel in control of their retirement? What is home ownership as part of that strategy and how does that fit in amongst all the other asset classes? We go through residential and commercial considerations, what an SMSF actually is, the balances that people have. So all of this stuff was considered when we looked at the SMSF space and more on it in this research paper. So the evolution of property. Go get yourself that research paper. It's totally free at investorkit.com.au. And Jack, thanks for breaking down the finance world here. Lots of stuff unpacked. And if you want to go through that step by step, just rewind this episode again. Check it out and reach out if any of us can help you on that journey. Take care.
Game over.